So, good afternoon, students. Myself, Dr. Lakshmi Patay MG, working as Associate Professor at Government First Grade College, Koratakere. So, my title is Financial Accounting. So, today I am discussing session number 4. What is the topic? Theoretical framework of accounting. Under this topic, I am discussing about the principles, concepts and conventions of accounting. So, concepts and conventions of accounting. So, accounting principles are a body of doctrines commonly associated with theory and procedures of accounting, serving as an explanation of current practices and as a guide for the selection of conventions or procedures where alternate exist. Accounting principles must satisfy the following conditions. The first one is they should be based on real assumptions. The second one is they must be simple, understandable and explanatory. They must be followed consistency. They must be able to reflect future predictions. They should be informational to the users. So, accounting principles are rules of activity which are adopted by the accountant usually while recording the account transaction. The accounting principles can be classified into two categories, such as accounting concepts and accounting conventions. So, earlier the accounting principles are called generally accepted accounting principles. So, accounting principles and accounting concepts and convention. Here are the principles of accounting, also known as generally accepted accounting principles. What is the first one? Business entity concept or principles. It implies that a business unit is separate and distinct from the owners, irrespective of the forms of organization. A business unit has its own identity. The accounting equation, that is, assets is equal to liabilities plus capital, is an expression of the entity. So the business is treated as separate from its owners. Personal transaction of the owner are not mixed with the business transaction. That is the highlight of the business entity concept or principle. What is the second one? Money measurement concepts or principles. So money is the only practical unit of measurement that can be employed to achieve homogeneity of financial data. So accounting record only those transactions which can be expressed in terms of money. Only those transactions which can be measured in monetary terms recorded in the books of accounts is the second concepts. And third one is cost principles or cost concept. This concept does not mean that asset will always shown at cost, but it means that cost become basic for all future accounting for the assets. So asset recorded at cost at the time of purchase but systematically reduced its value by charging depreciation. So assets and services are recorded at their original purchase price, not current market value. Accounting period principles or concept. This is also known as concept of definite accounting period. According to this concept, the life of the business is divided into suitable accounting period. The division is made to ascertain the profit or loss of the business for a particular period, that is 31st March, and to know the financial position of the business on a particular date with the help of the balance sheet. So accounting period principle, financial statements are prepared for a specific period, quarterly, annually, what? To measure their performance. Next one is going concern principle or concept. It is assumed that business unit is expected to continue at profit for an indefinite period of time. A business is deemed to be going concern and not a gone concern. It will continue to operate in future also. Transactions are recorded in the books in view going concern aspects of business unit. It assumes that the business will continue to operate indefinitely unless there is evidence to the contrary. The next one is dual aspect principle or concept. According to this concept, every financial transaction involves twofold aspects. One is yielding of benefits and giving of the benefits. For example, if a business unit acquired an asset, it must give up some other assets like cash and obligation to pay for it futures. So every transaction affects two accounts. Next, matching principles. That is matching concept. It is based on accounting period concept. The main objective of running its business to ascertain profit periodically. The determination of profit for a particular accounting period is essentially matching the revenue recognized during the period with the cost allocated to that period to generate the revenue. By matching the revenue with the expired cost, the balance represents the net profit or net loss for the period. Herein expenses should be matched with the revenue they help to generate during the same accounting period. Next, accrual principles or concepts. The essence of this concept is that revenue is recognized when it is realized. That is, when a sale is completed or services are provided, regardless of whether the cash is received or not. Similarly, expenses are recognized in the accounting period in which they contribute to earning the revenue, whether the cash is paid or not. So, revenue and expenditures are recorded when they are earned or incurred, not when cash is received or paid. So, another one is realization concept. According to this concept, revenue is considered as being earned on the date at which it is realized. That is, on the date when the property in goods passes to the buyer and he becomes legally liable to pay. Another one is objective evidence concept. There must be some evidence in ascertaining correctness of information reported. Entry in accounting records and data reported in financial statements must be based on objectively determined evidence. So these are the accounting concepts or principles. Now we are discussing the conventions of accounting. So accounting conventions are the traditions, usage and customs which are in use since long. The most of important conventions which have been in use are consistency, disclosure, conservatism. So what is the first one? Convention of consistency. The convention of consistency means that same accounting principle should be used for preparing financial statements for different periods. It enables the management to draw important conclusions regarding the working of the concern over a longer period. It allows a comparison in the performance of different periods. If different accounting procedures and processes are used for preparing financial statements of different years, then the results will be not comparable because this will be based on different postulates. So under consistency principle, the same accounting methods must be applied consistently over a period for comparability easy. Next one. Convention of full disclosure or full disclosure principle. The disclosure of all significant information is one of the important accounting conventions. It implies that accountants should be prepared in such a way that all material information is clearly disclosed to the reader. This information should not only include figures given in the final account, but also information which occurs after the preparation of balance sheet but before the presentation of the financial statements. The idea behind this convention is that anybody who wants to study the financial statements should not be prejudiced by concealing any facts. You should be able to make a free judgment. So in a full disclosure principle, all relevant financial information must be disclosed in the financial statements. Next one. conservatism principles or convention of conservatism. It means taking glory way of situation. It is a policy of caution and had its origin as safeguard against possible losses in world of uncertainty. It complies the businessman to weak risk-proof jacket. For example, closing stock is valued at cost or market price, whichever is less. Reserves are maintained by the concern to meet unanticipated losses. Next one, convention of materiality. Whether something should be disclosed or not in the financial statement will depend upon whether it is material or not. So materiality depends on the amount involved in the transaction. For example, minor expenditure of rupees 20 purchase a waste basket may be treated as an expense of the period rather than an assets. Next, we discuss about the accounting equations. What is accounting equation? Accounting equation is the foundation of the double entry bookkeeping system. It shows the relationship between a company's assets, liabilities, and owner's equity. What is the basic accounting equation? Assets is equal to liabilities plus owner's equity. That means everything the business owns, assets, is financed by either borrowing money, that is liability, or using the owner's investments, that is owner's equity. So components explained. Assets, the economic resources owned by a business. Example, cash, buildings, inventory, accounts receivable. Liability, debts or obligation owed to outsiders. Example, loans, accounts payable. Owner's equity, that is capital, the owner's claim on the business after liabilities are paid. Example, capital contributed, retained earnings. Expanded accounting equation, assets is equal to liabilities plus capital plus revenue minus expenses and drawings. So revision. So accounting concepts and conventions form the fundamental framework for maintaining uniformity, consistency, and reliability in accounting practices. Accounting concepts like the business entity concept, going concern, accrual, and matching ensures that financial statements reflect a true and fair view of business operations. On the other hand, accounting conventions such as conservatism, consistency, full disclosure, and materiality guide the practical application of these concepts, helping accountants make objective and prudent judgment. Together, these principles promote transparency, comparability, and accuracy in financial reporting, enabling users of financial information to make informed decisions with confidence. Dear students, these are the reference books I mentioned here. You go through and upgrade and update your more information. Thank you very much.